investors, we Indians have understood the power of equity and, of course, equity mutual funds over the years. We've seen the wealth effect at play. So while we rush to buy the dips in the market, the question I'm asking today is, do we give enough thought to creating a well-balanced portfolio? Do we give enough attention to asset allocation? Markets can be volatile and life can be uncertain. Are we prepared? What should be the asset allocation and portfolio construction strategy, not for 6 months or 1 year or even 6 years, but for long periods of time as we look forward towards planning our wealth and our finances? That is what we're discussing on the show today. And helping me answer a lot of these questions, I have two guests joining me. We have Mr. D.P. Singh of SBI Mutual Fund and Feroze Azeez of Anand Rathi Wealth. Gentlemen, thank you so much for joining in. Feroze, your opening thoughts.
See, when it comes to investing, asset allocation is very critical because that determines 90% of your fate of your money, point one. Point two, as longevity goes up of human beings, right? In India, the longevity of male Indian has gone up by 25 years from independence. Wow. So you have more number of years to live and you will not work till the last breath. So you're going to be investing today to be able to live the same lifestyle you're living today. So it becomes even more important as longevity goes up. And thirdly, it's very important that you don't go for hot funds, like you said. Now, very, very important. See, you have to choose your objective. As an individual, do I want to make money or do I want to make wealth? You can get the best stock.
That's very interesting. Do I want to make money or do I want to make wealth? And what's the difference between the two?
See, to make money, you will have to take hundreds of several right decisions. Get this fund, you enter at the right time, you exit at the right time. You have to outsmart the market to make money. To make wealth, you have to out-discipline them. You can be the most disciplined person and you will create wealth. To make money, you have to outsmart people. That's a rat race which is very difficult to win. And you might get money, right? I buy the best stock. Let's assume I found a tip of a mutual fund. Let's speak of mutual funds. I buy that fund and it rose 20% in the next 1 year. Okay?
I made money. I'm happy.
I made money.
Yeah.
But if you put 1% of your wealth in it,
yeah,
that's just going to be party money for you.
Oh, if you've not thought through the whole investment.
Right? Can you put 30% of your money in a hot fund? You can't.
Yeah.
Right?
So that's I think something that we really need to think about. It's great food for thought as we start off. Feroze, I want to club this with another thing that we've typically seen. So when we talk asset allocation, which basically means that should you be in equity? Should you be in fixed income? Should you be having more gold in the portfolio? Along with, the risk appetite part of it, another thing that comes into play is what is the market doing right now? So if gold has moved up 20%, suddenly you'll hear people talking about, "Arey, mera gold allocation kam hai. Maybe I should, put little bit on gold." It's just human behavior and human psyche, right? How do we avoid it? What is the right approach? Risk and also looking at market movement, volatility. Should we ignore it totally? But then we're humans at the end of the day.
No, you can't ignore it completely, nor can you embrace it completely. If you have a strategic asset allocation, stick to that allocation in spite of the decibel of the noise you hear. It is like somebody playing music, but the room is filled with 100 people who are talking. You will not hear the music. So you'll have to cut the noise to hear the music. So how do you cut the noise is the most important thing. Out of which some information is going to be important to you. So asset allocation, like DP sir said, is very critical. Now second, marrying your asset allocation with your risk appetite is a puzzle to solve. Most have not been able to solve. Right? If I asked a client, what's the risk appetite? He is not or she is not able to articulate to me and they're only using English words, saying that high risk appetite, low risk, medium risk. So to be able to marry the asset allocation with your risk appetite, you will have to make sure that you understand what are the types of risk which will impact which money of yours. Okay. I can't agree more with what DP sir said. In fact, that was food for thought for me. We classify ourselves as high risk, low risk, medium risk.
Yeah.
Everybody with high risk can have some money in low risk. And somebody in the low risk category will have to have some money in a high risk portfolio if it is for his retirement or her retirement.
Yeah.
So to answer your pointed question, I personally think that you should definitely try and marry your asset allocation with the risk appetite, and that's going to be critical. If you see some asset which has done very well over the last 1 year, you will always be tempted.
Yeah.
See, I remember having done a show with you in 2017, 1st January, 2017 or 18. The largest portion of question was, can we not have crypto in our portfolio?
Because cryptos were the new hot thing in
Absolutely.
town. Yeah.
And I think the viewer also asked why, because that's called recency bias. That is a very important bias which we all as investors have to fight. We will be influenced by what happened in the last 1 year. That bias is called a recency bias.
Very important. And I guess going over, above and beyond those biases is the first stepping stone to have a disciplined, statistical, mathematical, planned way of having a proper asset allocation in the portfolio. So factors to keep in mind, Feroze, when you're looking at asset allocation, what are the most critical things that you should ask yourself, you should evaluate before deciding debt, equity, gold, what you need?
So there's several factors, but I'll stick to only one factor to drive home the message. It's time. Okay, and generally a goal with longer periods of time should have equity. Why? Because there's not just market risk. Market ki utar chadav is what takes away mind share of an investor. But there's another risk, which is inflation risk, right? So that risk becomes a far more overpowering risk. If you had 100 rupees, okay, now whatever you could buy in 1980 with 100 rupees, today you need 4,800 rupees to buy the same commodity. Now you may be very happy that my 100 rupees has become 500 rupees in a fixed deposit. But if you take your 500 rupees to go buy that commodity, you don't get it. So time period is the most important variable, I personally think.
Feroze, since you brought up this point that a lot of young investors are coming in and that fixed income part of their portfolio, they'll probably not touch it for a good 7, 8, 9, 10 years, right? So instead of putting money in a pure fixed income fund or leaving it in your bank deposit, if you were to play fixed income through the hybrid, more tax efficient route, then give us 2 or 3 funds, categories, I mean, at least the category prototypes that you think make great sense if you don't need that money for at least 5 years.
See, I think hybrids most of the hybrids have become tax efficient. Because like DP sir said, even the 35% equity guys get taxation of equity long term, 12.5, after 2 years. So as long as...
Within hybrids, because there's conservative hybrid, there is balanced advantage. There's so many different types of hybrid funds, right? So it's a little complex for the investor.
If you are a young viewer, be rest assured that debt is more risky in the long run than equity. Debt is the riskiest asset class where you are sure to lose. If you're going to own something for 10 years and you're sure to lose the purchasing power of your money, there are very few risks which can be near certainty. This is post-tax, you will surely not beat inflation. In debt in a country like ours.
So you should not be in debt for 10 years if that's your time horizon.
Only like young people might also, like DP sir's point again, sorry, I'm reiterating, if there is a young person who wants to buy a car in 2 years, that's a separate portion of the money. That you have to be conservative. You can buy an arbitrage fund or a very conservative hybrid fund if you have 3 year plus.
Hi, I'm Samrat from Bangalore, and my question is, keeping a long-term horizon of 20 years for SIP, what should be the ideal mix of the portfolio with max 4 mutual funds in it? This money can be used for building a retirement corpus. Thank you.
Okay. All right, Samrat, let me toss that to Feroze straight away. 20-year SIP money. He's saying, give me, 4 funds.
See, firstly, I think if there is a retirement objective, try and marry your objective with the objective of the fund. Now, DP sir is here, and incidentally, SBI is the largest asset management company in the country, right? So, and it's the only asset management company in my model portfolio has 3 schemes. Okay, never has it happened in the last 12 years we've had it. So, leaving that apart, so like you have an SBI retirement fund. Okay, if you marry these 2 objectives, you're more or less certain that the fund manager is also looking at really long term. What is happening of late is diversified equity funds have this tendency wanting to beat their counterparts every single month. Your objective is 20 years, right? A retirement fund will not be so hell-bent on trying to beat its benchmark or its peer group every 1 month, every 2 months.
Absolutely. And the final
Whenever you look at a fund which is a locked-in fund, stick to the top 2 AMCs. Because you would want to have the kind of depth in analyst which can stand the test of time.
Sure.
Like, I would look at not beyond the top 3 if I'm locking in my money.
Okay, fair enough. We've run out of time, but not out of questions. But I think it's a great starting point. Asset allocation is something we need to keep in mind. We need to be disciplined in our approach and look at our goals and try and find solutions depending on the goal that we are trying to meet.